Hello all and welcome to another video from Vize Finance. Today, we will be discussing what bonds are, how they work, and how they can be beneficial to you. Surprisingly, bonds can be dated back to thousands of years ago. The use of bonds will grow exponentially over centuries, with governments and companies using them as a source of funding. The first government bond would be issued by the Bank of England in 1693 to raise funds for the war against France at the time. Investopedia defines a bond as a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are resourceful for governments because the funding could be used for roads, schools, dams, or other infrastructure. They can even assist the government during sudden expenses of war. Corporations have the same intentions as governments when it comes to bonds. They tend to raise funds. The difference is that corporations use them for their own needs to grow, such as buying property and equipment, undertaking profitable projects, research and development, or to hire new employees. Here's a quick example of how bonds work. ABC Company is in dire need of raising funds. ABC Company begins to issue bonds at $1,000 face value and a coupon rate of 5%. You as the investor are the lender and agree to purchase the bond under certain conditions that include the company paying $50 each year in interest over a 10-year period. Bonds have a maturity date, which is the date the company pays you back the principal, the original investment, on top of the agreed interest. You as the investor or lender will profit off the money you lended from ABC Company. What makes bonds attractive are the fact that they are a predictable stream of income. Bonds generally pay interest twice a year. Not only do bondholders receive interest, they receive their full principal at the maturity date, which makes them great for preserving capital. Bonds are also an alternative for holding stocks, especially when the stock market is very volatile. Finally are the risks. There is no such thing as an investment without risk, and if there are, they are very few and far between. All bonds carry some degree of risk, which is called credit risk, or the risk of the bond issuer defaulting on one or more payments before the bond reaches maturity. There are many factors that can cause a bond issuer to default, which puts you at risk of losing some or all your income you were entitled to. In rare occasions, you can lose some or all of the principal amount as well. Thank you for watching, and please like and subscribe.